All right, everyone, we're going to go ahead and get started. But before we do any introductions and before we start the webinar, we wanted to talk about today. Today is obviously September 11th, and we wanted to take a moment to honor those and remember those who lost their lives in those tragic events. And we also would like to honor the heroes that risked their lives to save others. So we would like you to join us in a moment of silence. All right. Thank you, everyone. All right, and I just wanted to welcome you to our Invest in Your Future webinar. My name is Zach Egger, and I'm a Business Development Officer at the Credit Union. Before I introduce you to our host tonight, I want to let you know that this webinar will be recorded and it's going to be available for you to review tomorrow or at a later date as well. Also, if you have any questions during the webinar, if you could please type your questions into the Q&A chat on the bottom right-hand corner of your screen. We're going to have a portion of your the portion of the webinar, about 15 minutes, to answer those questions that you may have. And now I'd like to introduce you to our financial advisor at the credit union, Patrick Infante. Patrick has been in the industry for over 28 years, and before he joined LAPFCU, he worked as a senior VP at Wells Fargo, E-Trade, TD Ameritrade, and Bank of America. Patrick has a plethora of experience and is always ready to serve our members. All right, and without further ado, I'd like to hand it over to Patrick.
Thank you, Zach. Thank you, Zach. Good evening, everyone. Thanks for your time tonight. Thanks for spending time with us from your busy schedule. As Zach mentioned, my name is Patrick Infante. I'm the in-house financial advisor here at the credit union. I cover all the branches for wealth management, financial planning, life insurance, pretty much any financial need out there. I work for CUSO, by the way, Credit Union Servicing Organization. CUSO is a broker-dealer. Like any broker-dealer, we have advisors at different credit unions throughout the U.S. Some of my colleagues work at Westcom, Department of Water and Power, et cetera. I work specifically with LA Police, Federal Credit Union, LAPD, all the law enforcement. I'm really happy to be part of the team here. Quick story, I was on the waiting list actually for LAPD in my early 20s. They had a hiring freeze, so I went a different route. You know, I've been in finance for a long time, like Zach mentioned. The first good 10 years figuring stuff out, but I'm here to help out regardless. I go to all the branches, I go to covered by appointments, etc. In this presentation tonight, we're going to cover a lot of the basics, financial planning concepts. While there's not a solution that fits all, we're looking just to share some insights with you, help you understand, and help you think about your own, planning as we move forward. If we have any specifics, as Zach mentioned, we can answer those at the end. If it's anything more in depth, you can reach out to me. My contact information is here, of course. And having said all that, thanks again for your time, and we look forward to sharing with you this evening. This is some of the agenda we'll be covering tonight. We're going to be going over setting goals, right? Talking about goals, right? Typically the first step to any financial plan, okay? From there, we're going to go into other areas such as budgeting, emergency fund. We're going to touch on insurance, using credit, investing, of course, tax planning, saving for college, retirement planning, and last but not least, drop options, right, as we approach retirement. So first of all, we want to start with goals, right? We're all going to have a variety of goals. For basics, we want to have our goals be as concrete as possible, right? To help you focus on what's really important when you have goals. A goal that's well defined is going to be easier to visualize and easier to stick with. To help set clear goals, we can use the SMART technique. SMART is an acronym we use, which stands for specific, measurable, attainable, relevant, and timely. Okay, a goal that's specific, for example, is one that has a clearly defined description and detail, precisely what you want to accomplish. For example, I want to say for my child's college education is not a specific goal, but a goal that says, hey, I want to have the cost of 4 years of Stanford by the time my daughter or son is 17 or 18. it's clearly defined, right? More specific. With a goal that's measurable, this refers to a goal that you should be able to track and clearly know when you've reached it. For example, if someone says, "Hey, I want to have $1 million," right? Or sorry, I want to retire early. It's a goal, but it's not measurable. But if you say, "Hey, I want to retire by my 55th or 60th birthday," it's a goal that has a definite endpoint, right? Measurable. When we talk about attainable goal is one that's realistic and attainable, reachable, right? Goals should be challenging, but you should have a fair chance of reaching them. For example, someone says, "I want to have $1 million in 5 years." It's not really an attainable goal, right? For many folks. But if you say, "I want to have $1 million in the next 30, 40 years," could be very, very well attainable for most folks, okay, if you're planning correctly. Relevant goal is going to be one that makes sense to you and they reflect some of your values, something that makes you excited, right? So for example, I want to have $50,000 to $100,000 saved up for a down payment on my home. That's something that's relevant to you. It's exciting, okay? That'd be a relevant goal. Also, you must be able to set a time frame or a deadline for reaching your goals. So, for example, I want to pay off my credit card by the end of the year or by the end of next June. A goal that has a definite, clear deadline. Okay. Also, writing down your goals is going to help you keep track of them. Make sure you're on track. You're working towards the variety of goals that you have. So you want to write them down either on paper, maybe an app, and kind of track them as you go. Some basics again on how you work your goals. Next, we're going to go into budgeting. The first part of any financial plan really is to put a budget in place, right? That's what a budget would be. First of all, tracking your income and your expenses, right? A foundation of any planning. And to construct a budget, first, of course, you have to account for all your income, your net income after your paycheck, any other income you may have, interest you're earning, maybe if you have a rental property, rental income, government benefits, all the money you have incoming on a monthly basis. From that, you want to subtract all your expenses. And expenses sometimes can be broken down into two categories, right? Some of the regular expenses that you pay on a regular basis is your mortgage, right? Your rent, car payments, insurance, basic utilities, groceries. That's your main, ongoing expenses. Then you have discretionary. Discretionary expenses are going to be more optional items such as eating out, entertainment, gifts, vacations, right? Discretionary. They're at your discretions. Now, initially, it can be a little difficult to track and get a handle on some of your expenses. So you may want to track them down, on paper for a while, monthly, maybe even over a year, and keep track because some of these expenses, right, occur on a weekly or monthly basis, but some are seasonal. Right. For example, heating costs or air conditioning costs, right, in these hot summer months. Others can be occasional expenses like car repairs that might come up or gifts, right, holidays. So after a while, when you're tracking these, okay, these are going to be some, heavier bills coming through here, with the heating or air conditioning and certain vacations. So you want to make sure you have a good handle on what the average is of your monthly expenses. From that, of course, you're going to take and subtract your average expenses over a given period of time, typically a month or so, from all your income. And if you have a positive number left over, that's a good thing. You're in the black or you have a surplus, right? And of course, a surplus can be converted into savings or investments for the future. But if you do have a negative number, you're in the red, right? You're running a deficit. That's a problem. So if you're spending more than you're making, you have to address that first thing, right? So the only way to address that is either you're going to have to make more income, right? Maybe get a second job, maybe work some overtime. The other way is decreasing your expenses. And it's the discretionary expenses, the fun stuff, unfortunately, that's the easiest to reduce, right? So you can do a little bit of both. But again, you want to get that budget in place to at least break even, but ideally you want to have a surplus. And on the bright side, if you have a surplus, the first thing you want to start doing with that surplus, if you haven't already, is start creating an emergency fund, okay? And we're going to discuss that on the next slide here. The emergency fund is money that's going to be readily available for you if an unexpected expense comes up. That's also another foundation of any successful financial plans, because without money to fall back on, if something comes up, you maybe have to force to be tapped into other earning savings you have, right? You might have to tap some of the money you have for college or other savings goals. But if you have an emergency fund, it's going to be much easier to handle a job loss, temporary job loss, long-term job loss, temporary disabilities, or any event that might prevent you from saving for the future, right? Or tempt you to pile on debt. How much you should have in your emergency fund is another common question. Popular rule of thumb is you should have at least 3 to 6 months of your living expenses, right, put away for the emergencies. And should you save 3 months, 4 months, 5 months, or six? It's going to come down to everyone individually. Certain factors like, are you the sole earner in the household? Are there two incomes, one income, right? How steady is your job? You're in a seasonal job. Are there common layoffs? Things of this nature are important to really get that number down of how many months you should personally put aside for your emergency fund and have an adequate supply. Do you have health care in place, right? Disability insurance? Do you have other assets you can tap without penalty in an emergency? So these are all different factors in determining how many months you should put aside for the emergency fund. Another factor is where you keep your emergency fund is important as well, right? Probably in a jar or under your mattress is not the best place, right? Or even in a safe deposit box, not the best. You want to have it somewhere that's readily available and ideally try to get some interest on it, right? If you have your money in a savings account at a good rate, 3, 4%, whatever that may be, where you can access it with no penalty. If you have it in CDs, certificates of deposit, a lot of those will have a penalty if you take money out, right? Sometimes it's several months of interest. So again, something that's giving you some good interest, especially now we're finally in a better interest rate environment. We've been in a better interest rate environment, and where you can access the money should you need to, okay, for the emergency fund, some basics on that. Now we're going to discuss on the next slide is going to be risk management with insurance. Again, another important part of financial planning is determining and managing potential risks that can come up and impact your finances, right? Insurance is really a cost-effective way to mitigate risks that can come up. So we're going to spend a few minutes and go over some of these basics. A lot of us all have these in place already, right? Number one, health insurance, of course, as we know, helps pay for medical care when you're sick or injured. Most healthcare plans provide basic coverage for medical expenses, doctor visits, right? Preventive care, diagnostics, hospital and extended care, emergency services, and some prescription drugs as well. Auto insurance, again, another common one, has two main components: liability and property damage, right? So liability would provide protection for those people that may want to sue you if you're at fault, right? They're, maybe for their personal injuries, their medical payments, any loss of earnings or damage to their property, right? So very important to have, of course, requirement as we know. Property damage ensures collision and comprehensive coverage, right? It compensates you for damage to your car caused by other folks. Also things as fire, theft, and vandalism. So, okay, so property damage. Next, we're going to touch on life insurance. This offers income replacement to your survivors. It provides a tax-free death benefit, okay, that can be used to pay off your mortgage, right? So you want to, if you have life insurance, you want to make sure you have enough to pay off your mortgage, other bills, car loans. God forbid something happens to you and you're the sole earner of the family. You want to make sure your family's taken care of. The cost and availability of insurance depends on many factors, right? Your age, your health, and the type and amount you want, what your death benefit is going to be, $500,000, $1 million, et cetera. And life insurance, there's term insurance, which typically goes for a term, 10 years, 20 years, 30 years, and permanent, which is there forever. I typically like permanent because you're not going to outlive it. And the permanent policies also build cash value. So that's important to know. And we can run illustrations on those and tell you, hey, after 10, 20, 30 years, this is your cash value. So a lot of intricacies on life insurance. And again, permanent is what I'd look at for most folks. Property insurance, of course, one of our most valuable assets is our home. And the most common type of homeowners policy in use today can cover a variety of risks that can cause damage to your home or personal property. It can also cover medical payments to anyone that's injured in your home. Also loss by theft or damage to your personal property, right? So that's all part of property insurance. And again, they typically can add in some of your personal property, clothing, jewelry at a certain dollar amount. Liability insurance is typically your last line of defense against claims, and this is often called an umbrella policy. It's a policy that's taken out typically over all the other insurance you have, all the other liability you have, and it's usually added in at about $1 million as an umbrella policy, just an added level of coverage should your other insurance, not hit the max. If somebody's suing you for several hundred thousand, right? A liability and umbrella policy is going to come in and cover everything else above and beyond. Disability insurance covers you if you can't work for an extended period of time, if you're injured or you're ill, right? If you can't work for a while, how are you going to pay, right? Replace your earnings, who's going to put money into the savings accounts for all your goals, can be used to help maintain your lifestyle, right? And give you time to recover. So this is important insurance to have as well. Long-term care here at the bottom is private insurance that's going to pay for benefits should you need them as we get older. Extended care, such as nursing homes, right, assisted living. These are things we don't think about as much, but when we get older, right, maybe the kids are growing up, you're on your own, you got to go into an assisted living. These can be very costly, right? A lot of wealth can be wiped out by going into these kind of centers, 5,000, 7,000 or more a month, right? So really adds up, and all this long-term care can typically be built into some other insurance policies, as a rider or as an add-on. So something to look at as well. Okay. Now we're going to discuss credit. Once we have established an emergency fund, we've insured ourselves against risks, right? And we have a budget somewhat in place, but sometimes we're going to need more funds than our budget might cover at any given moment. That's where credit's going to come in, right? So a word of caution here on credit, by the way, folks. Don't rely on credit to cover your normal living expenses, right? If you're using credit cards and such to pay for your normal living expenses, you could be heading down a financial disaster, right? Because if you don't have money and you haven't budgeted for your expenses and you're using credit, it's definitely something that we recommend against. By the way, the Webster's Dictionary defines credit as a provision of money, goods, or services with the expectation of future payments. So when it comes to big finance items, like big ticket items such as college education, a home, a car, most of us are going to need some type of loan, right? And that's where many times, credit's going to come in. Also, like we're going out shopping for Christmas or going on vacation. Sometimes it's just more convenient to use credit in the form of a credit card to make purchases. But we want to also make sure the more credit we're taking on using credit, we want to make sure we're budgeting that into our right expenses every month. How the lenders decide on how to grant credit comes down to the 3 C's, as they call it. First of all, is the capacity. Creditors are going to want to know what is your capacity to repay the loan that they're granting you, right? They want to know factors like your income, how long you've been at your job, your expenses. So they're looking at your budget as well. Once a creditor determines that you can repay a loan, the next question is going to be, will you, right? And whether or not you're going to pay a loan comes down to your character. This means they're going to look at factors as your stability again, how long you've had the same job, or how long you've lived in the same place. If you've used credit in the past, they will also want to look at your repayment track record and how have you repaid your bills, right? Have you been late, 30 days late, 60 days late? All this gives them an idea, how likely you are to meet your your loans, right? Also for larger loans like car loans or mortgages, the creditors want to look at some collateral, right? Collateral will be backing up the loan should you not pay, right? Your home would be a collateral loan, of course, your car. So if you default on the loan, unfortunately, they're going to come and repossess your car or maybe put a lien on your house, lose your home. Some basics, right, that we're pretty much familiar with, but just some basics that we're going over here. Also, creditors are going to determine your credit worthiness by examining 3 documents. Your credit application, right? They're going to see how much income you're making and the source of your income. They might ask about, again, your recurring expenses and other debts. They're going to look at your credit report. It's going to give them a good idea of all your repayment history again and how have you paid your bills off. And of course, they're going to look at your credit score, right? your FICO, as they call it, right? This is statistical information that analyzes all your information from your past credit and your history, and it gives you a 3-digit number that tells them how likely you are, to pay off your debt. And obviously, the credit is important. The FICO could be as high as in the 800s, right? From 500 on up. So you want to make sure you focus on your FICO or your credit score and try to, keep it as high as possible, because the better your credit score is, the better terms you're going to get if you do get a loan, right? A better interest rate, better terms, etc. So definitely good factors to know about when you're using credit. Okay, so managing debt. Once you are granted a loan or you use a credit card for debt, right, you're creating debt. And we can use debt as small purchases, right, like on a credit card that we can repay quickly. Others are large, right? A home mortgage, student loans that could take years to pay off. And how well or poorly you meet this repayment schedule, okay, is going to have an ongoing effect on your credit history and your credit score, right? So debt can be divided basically into 2 types, as we discussed before: secured and unsecured. Another example again here: secured is backed up by a lien or collateral. Again, an example could be your mortgage, your home equity line, right? A HELOC, a car loan, or secured credit card, right? Sometimes when you're starting off, you don't have much credit, you might get a secured credit card to kind of build up your credit. Unsecured does not place any lien on any real estate or personal property to secure it. Examples, of course, for unsecured loans could be student loans, installment loans, which are personal loans, and most credit cards, again, unsecured debt. When you're thinking about taking on debt, a few factors to consider. The amount, of course, that you're going to borrow is going to have a big impact on the size of your payment, right? No matter what the term or the length of the loan, you have to repay that every month. So we want to make sure you're budgeting that, right? How much is your payment going to be? And the interest rate you're charged is going to also be a factor in how what the size of your payment is. When you're looking at the installment loan or the term, okay, the length of time you're going to pay it, generally, the larger the loan is, okay, it's going to take you longer to pay it, and the more interest you're going to pay over that period of time. So you want to keep that in mind as well. Revolving credit accounts like credit cards don't have a minimum, a fixed amount you pay every month. They typically have you pay a minimum, right? Also, something to be aware of, as you probably know, if you're just paying the minimum every month on your credit card, it's going to take you forever to pay that off, right? So very advisable to pay extra, pay down the principal if you have unsecured, right, debt like credit cards, because again, paying that minimum is not going to get you anywhere. The interest rate, of course, that you're charged on debt will affect the total interest you pay over the life of the loan. The higher the rate, the greater interest you're going to be paying over the life of that loan. So these are all factors to look at, and all this ties back to your credit history, right? Your credit score. So you try to get the best terms possible, and by building up your credit over time. Okay, next slide here. We're going to go into investing. Okay, we've talked about using credit, okay, and the potential for accumulating debt. We'll talk some basics here about investing and the potential for accumulating wealth. Now, question, do most of you folks associate investing with speculating or gambling? Do you think of it as betting on the market, what it's going to do, or maybe try to time the market to make a quick profit? Or do you see it more of as a long-term methodical approach to saving for the future? So sometimes it might be a little bit of both for some folks. We may have long-term money, of course, right, that's growing for retirement. Sometimes you might have some shorter-term money you want to get some better interest on, or hey, maybe the market's down, or there's a stock you want to buy, or try to grow some money shorter term. So again, it could be really a combination of both typically, and they kind of go hand in hand. So when you're planning for your investment strategy, it's really about discipline and patience and having really a well thought out approach. And you want to be managing your investment, right, and reviewing it to make sure it's on track. So money will fluctuate, as we know. Typically, the more fluctuation could pay off better, right? More volatility, more up and down. If you're in growth, right, it's going to be a lot more volatility with the exchange of bigger returns. If you're something stable, like a savings, a CD, a lot more conservative, right, lower risk, lower return basically is the difference there. So depending on your risk and et cetera, we can always look at these factors and see what might be the best investment solution for anyone's specific needs. Okay, here again, we're going to talk more detail about risk tolerance. When it comes to investing, again, there's a direct relationship between risk and return. That is, again, the greater potential for return increases, so does the risk and the volatility. Or the less risk an investment has, the lower potential return, right? So when we look at the investment plan that's going to be appropriate for everyone, it's going to largely depend on your own comfort level, right? What's known as your risk tolerance. There are ways to manage risk these days, of course. We can have protection, of course, even if you're in growth. Hey, I want to be in growth, but I'm a little bit more risk averse. I want to have some kind of safety net there, some kind of buffer. So there are strategies out there to do that. But how comfortable you are with the risk is going to be really a subjective matter, right? And depending on your history, how long you have for the investment, what stage of life you're in, right? So these are all different factors. Everyone's different, but again, we want to build a customized portfolio for everyone and make sure that we're on track and we're really prepared for any volatility that may come. The second question is how your investment is going to be handled potential losses, right? Like this year, we've had a lot of volatility. The market was up 10% through March. We came down 4%. We hit a high of 18, 19% through June. Now we're up about 15. So it's been a lot of up and downs and looking for growth this year. But again, we're still up 15%. It's really been a good year. So you want to have an idea. And when we invest, we want to look at historical performance, what the outlook is going forward, how's the economy doing, right? So there's a lot of factors to consider, and I can help, again, create a specific, personalized approach for everyone, depending on what their needs are and all their risk tolerances and their time horizons. Okay, next slide. We're going to go over growth, income, and stability. Several key terms that we use quite often when planning and investing. We all know these terms, of course. Growth, as I mentioned before, when you invest for growth, you want to have the money growing and be a bigger value than what you started with. To grow in value, okay, you should be able to sell and come out at a gain depending how long you invest for. Typically, when we're younger, we're trying to grow our money, right, to have growth over the years. The market average is about 11% a year, by the way, historically. The last 5 years, the market's done about 15% a year. So again, that's why we typically want to be investing in the markets for our retirement money when you're trying to grow money. As we know, 401ks, 457 plans allow us to go into the market, and you can build customized portfolios depending, again, on how much growth you want, if you want a balanced portfolio, et cetera. That would be the growth side. When we look at income, right, income is going to be paying you regular payments of interest, either on a monthly basis or at maturity. So when we look at income, it could be dividends from stocks. It could be certificates of deposit that pay monthly income, or bonds that pay you interest, right? More of a stable payment, something that's going to be a lot more stable just to give you an interest payment. And again, there's a stage in life when we're trying to grow our money and build up maybe $500,000 or $1 million, right? If I have $1 million saved up and I can get 5% a year and live off the interest, that's $50,000 a year, right? And you're getting a check every month and you're not touching your principal. So the idea for me and my members is, hey, what stage are we at? Let's try to grow this money so when we go into retirement, we're going to have another bucket of money here, right, to generate extra income off of. So there are different stages of life, of course, right, and different buckets of money. You might have your growth money that's in growth. You might have other money that's going to be more your conservative money that's either in a savings account, maybe a CD, right, at a fixed rate, or maybe a treasury. A lot of treasuries are popular right now, right? The T-bills, treasuries pay you a fixed rate with a set maturity, and they have no state tax. State tax here is about 9.3%. So again, a big savings on the interest you're making on treasury. So all these products kind of tie in together. And again, different buckets of money for different objectives. Then stability, of course, the third potential objective of investments refers to helping preserve your principal. Kind of what I talked about before. You're looking for something stable that's just going to give you an interest payment. That's going to be a certificate of deposit, a bond. These are investments that have a set due date, right? A CD, as they're called. Hey, it's going to expire in 6 months or 7 months, a year. You get your principal and interest at maturity, or you get the interest along the way. and your principal stays stable, right? And you get the principal back at maturity, and you roll it over again for another 3 months, 6 months, depending on what the rates are doing. Currently, we've been in a declining interest rate environment. Unfortunately, rates were going up for a while last year. The Fed was raising rates, right? Raising rates. Now, finally, rates are starting to come down. Right? So we've seen the days of 5% are harder to find. We're getting fours, but there are still some good rates out there. So anyone that's sitting on money, typically from my members, when rates are going up, they're getting better and better. We're staying shorter term. We're rolling over 3 months, 6 months. But when rates are coming down, is the time you want to lock in a little bit longer, maybe a year, 2 years, 3 years, and lock in that 5% if it's still available, right? So just some basics on stability, rates, and growth. Okay, folks? Okay, income tax considerations. We want to spend some time here on, pre-tax dollars, deductions and such from your paychecks, right? Most of our employers offer us some ways to do pre-tax contributions, not only for retirement, but also some employers offer you to pay for some expenses. For example, some people that have pre-tax money going to medical, of course, dental. Some employers have you can pay for expenses like let's say a commuter pass. Let's say you're taking public transportation and that pass costs you $100 a month. If you can pay that pre-tax through your employer, through your work, your pre-tax money, instead of costing you $100, that might only cost you $78. So again, it's good to inquire and know, hey, what's available pre-tax other than the medical, the 401k, right, your retirement account, any other benefits that are pre-tax. Some folks, depending on your business, you might have a budget that you're putting money into, right? Like healthcare is another one. The health savings accounts, or as they're called, the fixed savings accounts. When you go to the doctor and you have a copay, you have this money you've put aside pre-tax to help pay for really copay is good, or any other expenses you have at the doctor's office you have to pay out of pocket. Again, those are accounts you can fund pre-tax, so it's just an additional savings for you. Okay, so to be aware of, again, flexible spending accounts or health savings accounts. Also, we're going to discuss over here tax-deferred growth. Okay, as it says, tax-deferred growth means there's no taxes until the funds are taken out. This is going to be typical of your 401ks, retirement accounts, right? 457, all tax-deferred growth, and we don't pay taxes until you start taking it out. When we're planning for retirement, of course, most folks will not touch the money till they do retire. The benefit is when you start taking money out when you're retired, ideally, most folks will be in a lower tax bracket. So instead of paying 22% federal tax or 24% tax and a higher state tax, ideally you might be making less income when you retire. So you're going to have to pay less taxes is the idea. Just deferring that tax as long as you can. Most folks will just wait until they're retired, and some folks will plan around that. Also, there are accounts where you can grow tax-free. Okay, some examples are going to be 529 college savings accounts. Those grow tax deferred, and you can take the money out for college expenses, tuitions, anything education related, right? Tuitions, uniforms, anything that's going to be related to college or education are key to use the college 529 savings accounts. So also a new legislation came out. If you have money in a college savings account and you don't use it all, you can now convert it to an IRA. So if you have kids, saving for college for them, and they don't use all that money, or they get a scholarship, again, you can convert that money into an IRA for them as well, which is a nice benefit to have these days. So some basics there on that. Also, with both traditional and Roth IRAs that do allow tax-deferred growth, okay, be aware that if you start taking money out before you're 59 and a half on the IRAs, there's a 10% penalty, all right? That's to deter you from taking your retirement money out. So you want to wait at least till you're 59 and a half before you start tapping some of the retirement money, right? One thing also, though, for the officers in the 457 plans, there's an exemption to that 10%. So if you have a deferred comp account, 457, there is no 10% penalty if you take money out before you're 59 and a half. So it's good maybe to, if you have money there, you're taking some out, leave some there always, so you can always have a resource to get money out without a penalty if you're not 59 and a half yet. Okay, so those are some basic things to consider around taxes, pre-tax, and tax-deferred growth. Okay, next slide we're on here is the tax deferral, the value of growing tax deferred. This illustration here is going to show us, assuming you had $20,000 to invest, okay? If you put in $10,000 into a taxable account, right, earning 6% a year, and you use a portion of that interest you're getting to pay taxes every year, right? Because it's a regular account, you're getting 6%, you're going to get a 1099 every year for the interest you've earned. You take the other 10,000, you put it into a tax deferred account, right? So something that's going to be like an IRA, something where you don't pay taxes. There's other accounts you can use as well, other than IRAs, where you can get tax deferred growth or interest. Assuming you have the same 6% over 30 years, okay? On the taxable account, in this example, they're using a 24% tax, okay? If you're paying the tax every year, okay, it's going to be coming out of the profits you're making, right? So in the same amount of time here, if you invested over 30 years, the tax deferred account will have grown to $57,435, okay, on the tax deferred account. If you're paying taxes every year after 30 years, the taxable account would have grown to $38,104. Okay, so a big difference, and that's the benefit of tax deferral, right? You're not paying taxes every year, you're deferring the taxes. On the tax deferred account, by the way, if you took all the money out after 30 years and paid the tax at that one point, you still have more. You'd still have $43,651 after tax, so still well ahead of the $38,104 in the taxable account. And this is a long period of time, of course, right? 30 years. But just understand the benefit of tax deferral. And again, there are investments you can use outside of the IRA that give you tax deferred growth, safety of principal, whether it's growth or income, and tax deferred. So all the gains, all the interest you're making, you don't pay taxes till you start taking it out. A lot of members say, hey, Patrick, I have this money here. I want to put it away. Again, you look at some tax deferred income options or tax deferred growth, and you just keep kicking that tax bucket down the road that, try to not pay taxes as long as you can wait, right? It could be 2-3 years or longer. And eventually, even if you do pay the tax at the end, as we see here, you're still going to come out way ahead versus paying taxes every year. So something to be aware of on how tax deferral can really help compound the growth and the income. Okay, now we're going to jump over to savings for college. We touched on this before a little bit. Going to go a little bit more detailed here on the 529. One of the biggest expenses we have, apart from our home, of course, is saving for college, right? Can get very costly to put kids through college, grandkids. So we're going to spend a few minutes here. As I mentioned before, the most common plan these days is a 529. Okay, it's an individual account. The parents would be the custodians till the kids become of age, 18. And the college accounts are pre-established portfolios. They're really in mutual funds. So there's three main providers that we partner with for the 529 college savings accounts. American Funds, which is also known as Capital Group. They're the largest mutual fund family. We also have BlackRock and Putnam. And again, these are all mutual fund accounts. You can go into what they call target portfolios, which are okay. That means, hey, I'm going to need the money in 2030, for example, right? The target portfolios will invest for you a little bit more aggressively at the beginning. As your kids get closer and closer to college years, they'll start getting more and more conservative. So kind of like a predetermined portfolio that will continuously get more and more conservative. Those are okay as well, but just know that we can also go in and say, okay, if we're with American Funds or BlackRock, what's your best choice year to date, right, for the college account? Market's up 15.5. What's doing the best? So I kind of like to pick and choose depending on what the economy's doing, right? Sometimes if you're too conservative, I've come across some accounts where it was a college savings account and half the money was in bonds and half was in growth. I'm like, wait, your kid's how old? 5 years old? I said, yeah, good news is half the money's doing great. You're up 15%. The other half was in bonds. So you've actually lost 2% a year on half the money. So for me, it's really depending, and not only for college accounts, right? For any investment, you got to be in right allocation. If you're too conservative last year when rates were going up and you had half your money in bonds, or the classic 60-40 portfolio, right? 60 in growth, 40% in bonds. That section in bonds, the 3-year return is probably been negative 2 to 3%. So it really depends on what's going on in the economy. Is the market good? How are rates doing? Are rates going up? Rates go up, bonds go down, right? Now that rates are finally going down, the old 60-40 portfolio makes more sense. You can go into bond funds that are giving you a good coupon, 5, 6, 7%. and you might get a little bit of growth on top of it, right? As rates come down, the value of those bonds go up. So these are all important factors to look at when you're building your portfolios, not just for college savings, for your own accounts as well, your 401ks. And even for my members, we might be doing investments here with us at the credit union. But I say, let's look at your retirement money. Let's see how that's allocated to make sure you're in the right allocation. And I listen and talk to analysts all day, economists, and when I'm hearing this year, it's going to be a good year, double digits, 10% or more. Sure enough, we're up 15. We hit a high of 19%. June, July, and I relay all this information to my clients, right? So I try to guide you and help you build the portfolios for your kids, for yourselves, and monitor them along the way, right? You can't just put the portfolio there and not look at it. You got to look at it at least every quarter, twice a year, 4 times a year, ideally, at the minimum once a year. But with my clients and members, we're typically reviewing very regularly throughout the year. Some more things here on the performance here. Returns are not guaranteed, again, because they are in the market. So you want to make sure that you're in the right allocation. And again, funds could be used towards any education, right? The 529s are very flexible. You can go to any college you want and anything education related, even if you're an adult. Let's say you graduated, you're working, hey, I'm going to take another course to keep learning, right? You have that 529 money, you can still use that as an adult. On the right side of the slide here are prepaid tuitions. We don't see those as much anymore because they're more limited. You got to go to a college, a state college. On these prepaid tuitions, you're prepaying tuition at today's prices. Okay, the thought is, hey, it's going to cost more later, but they're a lot more limited to your state's plans, as it says there. And again, public colleges in states. So the majority of folks these days are doing the 529s. You have a lot better growth. Your money's growing at a good rate. And again, you can convert these into an IRA now. You have to be with the plan for 15 years. So if you start these accounts for your kids early enough, 15 years will go by real quick. And any money left over, again, right into an IRA. So some basics here on these college savings accounts. Again, some of the basics is going to go on, touching again on the 529, tax-deferred growth, right, and potential for tax-free earnings, as long as you use it for educational purposes. Again, anything education-related, uniforms, tuitions, books, etc. Withdrawals not used for education will be subject to taxes, right? Federal tax, state tax, and a penalty, right? Because if you're not 59.5, but again, typically you would roll that into an IRA. But yeah, it's subject to penalties if you don't use it for education. Also on the 529s, you can gift it, right? You can gift it to siblings, cousins, so it's very transferable. So something to be aware of. If you have kids, they can share the money and transfer it over. Fees and expenses per plan, which is correct on the 529s. There's typically a commission up front when you buy and you invest, but the returns far outweigh any fee you pay, right? It might be 2-3%, whatever you pay going in. But again, if you just stick with the plan, these are long-term investments, so the return is going to outweigh any fee you have to pay on those. But we'll know ahead of time what the fees are when you are going into the college 529 plans. Okay, we're going to go into retirement here, a little bit more basics on retirement planning. Before you can start planning for retirement, right, you have to ask yourself some basic questions. First of all, what kind of retirement do you want to plan for, right? Also, when do you want to retire? And how long will retirement last, right? Very important questions to know. Do you picture yourself, right, on a golf course, a beach, just relaxing at home? Most of us probably imagine a certain level of financial independence, right? We want to kind of be comfortable. And to a large extent, right, we want to be able to do what we want in retirement, travel, enjoy. So we want to really plan ahead for everyone's going to have a different, goal and different plans for retirement. And if you also thought about when you'd like to retire, it's important because the earlier you retire, the shorter time you have to save up money, right? And the longer period of time you're going to be in retirement. So most folks might plan retirement around Social Security. The earliest you can get Social Security is 62. And the earliest you can receive full Social Security is 65 to 67. So something to be aware of. You retire too early at 55, right? Something else to consider is your medical through the state, Social Security, Medicare and such, doesn't kick into your 65. So if you retire too early, that means you're going to have to pay out of pocket for health care for you, yourself, family. That can be thousands of dollars, right? Easily 1,000 or two, depending on the size of your household. So these are all important things to consider. Again, 62 is the earliest for Social Security, 65 for Medicare, right? So if not, you're gonna have to pay that yourself. And also, the earlier you retire, the longer your money's got to last, right? Stats show that we are living longer, so our life expectancy continues to increase. So it's very common that we might be in retirement for 25 years or more, right? So you want to be aware of that. How long is your retirement money going to last you? And again, that's why it's so important to try to grow the money as much as we can when we're working. The more you have, the more interest you can get. You have 500,000 saved up, great. If you can get 5% on that, 25,000 a year, most folks will take it out on a monthly basis, right, to supplement your income. Ideally, you want to supplement your income through the interest your money is earning, not depleting your principal, right? Not spending all that money. You want to have the interest income. So when I build portfolios for my members, we're looking for income at one point. If you're retiring or you have, hey, my objective is income, that's the first objective. But the second objective is how do we get some growth on top of that? Income is first. Second objective is growth. And then I'll back test portfolios, say, hey, this portfolio here has done 12% a year for the past 5 years, the past 10 years. If you're taking out 5, 6, 7% interest, your dividends, you're still getting some growth on top of that, right? 4, 5, maybe more percent growth. So these are important factors to look at when you're planning for retirement, all the considerations. But again, just knowing we're going to live longer, we want to have as much as possible as we go into retirement to make sure that it's going to last us, okay? We're going to go into the next slide here. Tax advantage savings, right? How tax deferral can help grow your money. We went over that a little bit earlier, tax deferred growth and how to take advantage of it. Some of these plans, as we discussed, are going to be your 401k plans, very, very powerful tools to help boost your overall growth, tax deferred. Also, in the 401k plans, a lot of employers will match your contribution, right? Whatever you're putting in, they might put a percentage matching. Some match dollar for dollar. This is great. This is really free money. It's going to help build your retirement. Even if you're not getting a match from your employer, the first place you want to start saving is your retirement accounts, 401k, 403bs, 457s, right? So that's the first place you want to start saving for retirement. If you don't have a plan offered through your employer, you want to do an IRA, right? Individual retirement account. You got to start putting money away somewhere. Another benefit of the employer plans, you could put much more money away, 20,000 plus, 23,000 plus a year. The contribution limit keeps increasing, so that's a big amount you can put in. Also, if you are self-employed, you'd want to set up a self-employed pension known as a SEP IRA, self-employed pension. Those are great because you can put a lot of money away in those as well. Example is, let's say if you're self-employed, you're making 100,000. You can put in 25% of your income into a SEP IRA. You made 100,000, you put in 25,000 to your self-employed pension. It brings your income down. You report that you made 75,000, right? Not 100,000. So again, that's a big number you can put away, 25% of your income, right there with the 401ks, 23%, 23,000 give or take in that limit. Again, it keeps changing, increasing every year. The IRA contribution limits are lower, 7,000. There's a catch-up provision as well. You can write those off as well, right, against your earnings. It's a write-off. The Roth IRAs, by the way, those grow tax deferred and you can take money out tax free. Roth IRAs are contributions you make with after tax dollars. Again, you cannot do a write-off on the Roth IRA, but the money grows tax-free. There was a time years ago when people did IRA conversions. They rolled over from a traditional IRA to a Roth. It was pretty popular. Some folks decide, I'm going to pay my tax now because I think taxes are going to be higher in the future, right? So we don't see as much of those big conversions, but a lot of 401k plans will give you an option to do pre-tax money and also Roth. So I would consider putting in money into your Roth as well. Again, that's going to be when you take that money out, no tax at all, which is really nice. Full tax-free withdrawal. It does have that 10% penalty if you take out money before you're 59 and a half, as it mentions there. So all these retirement plans, 59 and a half, even other tax deferred growth you can do, 3-year terms, tax deferred outside of your retirement accounts. If it's not, if you're not 59 and a half, those also have a 10% penalty. So there are things you got to be aware of, whether it's an IRA, a 401k, or any tax deferred growth. Some of those will have a 10% penalty for early withdrawals. Okay. The basics there. Now, last but not least, we're going to go into drop options. When to enter drop, right? Deferred rollover option program. As most of you may know, the drop is paying your pension into an account for typically 5 years. When should you go into drop? Should you go into drop for the 5 years and build another nest egg, right? Another bucket of money? I typically refer my clients to do, if you can do drop for 5 years, I highly recommend it. I've seen, balances of 500, 600,000 go just from drop alone. So when you retire after 5 years, you have your pension. If you have a pension, right? Some don't have a pension. Here we do at the LA Police Department. But the drop account's so important. So some folks, well, I'm going to do 2 years of drop. But again, it's paying into that, your pension, into the drop account for a higher pension. If you have 500,000 there, again, that's another bucket of money where you can get interest, 25,000 a year. Then you have your pension. Again, right? How many years to stay in drop? Again, I recommend if you can hang in there 5 more years, highly recommend that. What to do with your drop funds, of course, like any 401k. Highly recommended to do a rollover. When you do a rollover into an IRA from drop, from a 401k, it opens up so many more avenues for investments. You have all the mutual funds available out there. You can go into technology, which is up 35% this year. You can add protection to your growth. You might say, hey, I'm going to do a rollover. I want to continue doing some growth, but I want to have some protection now because I'm retired, right? I can't take that much risk. Let's say, okay, great. Let's put some protection on the growth, 20%, 30%, 100% protection, and you're still in growth. So again, a lot of benefits by rolling over into an IRA. And distributions, of course, you take the money as you need it. If you're on a pension, you're probably going to have a higher tax bracket, long term. Most folks that don't have a pension, right, when you retire, your tax bracket drops from, right, 22, 24, federal tax, maybe down to 12%. So these are all important factors that you can look at when to take distributions out. Most folks will take distributions out on a monthly basis. You don't want to take a big lump sum because that's going to put you into a bigger tax bracket. You might be in the 34% federal tax, right? Have a big tax bill the following year. So these are important factors to look at. And again, everyone's different. And that's really the most part about distributions. Try to wait as long as you can. When you turn 73 and a half now, the age keeps going up. At 73 and a half, you have to take RMD, right? Required minimum distribution. It's not a huge amount. It's about 4% of the account value, but something to be aware of as well. And again, some basics about drop. I help officers and other, employees with drop all the time. Definitely can look at that on a one-to-one basis. And that's going to end us here. We have about 10 minutes for questions. I want to thank you all for your time. Again, we went through it a little quickly, a lot of information, but we're going to go over some questions here with Zach.
All right, thank you so much, Patrick. We have a few in the chat, so let's get to them. So the first one is, what are my options for health insurance before I qualify for Medicare?
Yeah, but good question. Again, typically, as we know, for health insurance, the best it's going to be through an employer, right? So, if you have maybe a part-time job, a group insurance is going to be the most affordable. If you're fully retired, you get COBRA, which is temporary when you retire, but really you're going to have to shop around for insurance. You're going to go to some of the biggest providers, right? Farmers, et cetera, and see what the cost is. So it's going to be just a matter of shopping around, but unfortunately, group insurance to an employer, even a part-time job, right? If you can get a part-time job working however little hours possible, and you can join their medical, that's going to be the best bet, really.
All right. The second question is it okay to have debt when I retire?
Yeah, it's okay to have debt when you retire. Ideally, we want to pay debt off. We don't want to really carry debt. It's going to be part of your budget. So if you're budgeting for that and you have, okay, I have this debt, I'm going into retirement, I'm going to carry some debt into retirement. You want to have a plan how you're going to pay it off, right? So it's fine to have that debt, but again, you ideally want to pay it off. Even if you go into retirement, you don't want to carry debt, I think, for 10 years into retirement, right? You want to have it paid off if you can, but if you're going into retirement with some debt, you want to have a plan in place. Hopefully you have enough savings, right? Where hey, I have my retirement accounts. From this account, I'm going to get interest. This interest I'm earning on here is going to go to pay off my debt, right? So that's fine, but we want to have a plan how to pay that debt down.
All right. And then the next one is, can we schedule virtual or in-person meetings with Patrick?
Absolutely. We do them all the time. Virtual meetings, in person, conference calls, definitely readily available. We use Teams a lot, and we can do that anytime.
And then how would you go about doing that?
Typically, you reach out to me, send me an email. You can call me. We set up a time and a day. I'm also available on Saturdays. I know a lot of us work. I can do after hours, after 5 o'clock. I'm very flexible. So hey, how about Saturday morning or so, right? I'm available. So you reach out. Hey, Patrick, we do maybe a preliminary call, just 5 minutes. Okay, get your name, email, send you the invite, and kind of get an idea of what you want to discuss, what we're going to be going over, so I can have some kind of information or something planned ahead of time, some things to share with you. So yeah, pretty basic. Again, reaching out, phone call, email, and we can go from there.
All right. And then two more. How can I adjust my retirement plan if the cost of living increases faster than expected?
Give me that one more time.
So how can I adjust my retirement plan if the cost of living increases faster than I expected?
Yeah, you want to review your investments, right, and see what your returns are, right? If you're an investment plan, what's the historical return? Like, okay, if you've been in the S&P for the past 5 years, the S&P's done, which is the S&P 500 index, the benchmark is 15% a year. That's pretty good, right? So constantly monitoring your portfolios. If you have 5 or 6 or 10 holdings, we want to look at each one individually. You might have I have some large cap, I have some mid cap, I have some international, I have some an income, right? So every investment you have in your portfolio, we want to look at it on a one-off basis. How's this holding doing? How's this? And really want to make sure that you're getting at least a double-digit return that's going to keep you ahead of, right, the cost of living. So I've seen portfolios, hey, you have 4 things that are doing great, 3 are lousy, right? These 3 have made 1% all year. And like, oh man, I thought I had a good balanced portfolio, right? So again, you got to really go into under the hood on your portfolio. I use Morningstar software, which updates every month. I can tell you, hey, through August, the market was up 15 and a half. Some of the investments I use are up 20%, 30%, right? So it comes down to how your investments are doing and how you're monitoring them along the way and making sure you're in the right allocation at the right time. Another quick example, right? You want to make sure that if you're getting income, that's going to be an income portfolio that's protecting you against some of the risk. Interest rate risk is one risk, right? So things like that to make sure your money's still growing and giving you income if you are an income.
Great. And then we're having a few more coming in right now. When I exit drop and I do a rollover, do I roll over the entire drop amount into my current deferred comp, or do I have to split it up into IRAs and other types of accounts?
Yeah, good question. Typically, you do it all at once. We'd call Voya. They combine those and they just send you a check for the drop. You roll the drop into your Voya, and then typically they just send a check. By law, you have 60 days. What most members do, we call Voya together. They cut a check. They send it to you. That check comes, we scan it into your IRA within a week. The money's in cash. Then it's about how do we invest it now, right? You want to continue growing. You want to get some income. So yeah, you combine it to your Voya basically for that question. And it's all tax deferred, right? It's all pre-tax money.
All right, we got another one. I have managed stocks at a brokerage firm, and can I transfer those funds to LAPFCU?
You absolutely can. Yeah, we do that all the time. I've had many members I've helped out with some conservatives say, hey, Patrick, I have an account over here at this bank, et cetera. You can transfer those in. If it's an individual account, a joint account, right? Non-retirement money, we open an account, individual account. And that's done electronically. We can open, everything's DocuSign, by the way, so we can do it in person. We can get on the phone, go through your profile. It takes about 20 minutes. You send me a statement, and those positions would be here in about 7 to 10 days. It shows up really quick. It's all electronically done, so it's very streamlined.
All right, I've got another one is, can I roll drop directly into the self-directed option in our deferred comp?
You sure can. Absolutely. Yeah, you can. To be tax deferred to tax deferred. And I think you're referring to the Schwab self-directed portfolio. You can do that as well. I've had a lot of members come over from Schwab. Okay, you got to be careful what you're doing there, what kind of guidance you're getting there. I had one member come over last year with rates going up, 80% in bonds, right? And like, man, you got a lot of bonds in here with rates going up. Rates are getting better, and you got these bonds that are locked in for 10, 15, 20 years in a rising interest rate environment. So again, if nothing else, we're here as a resource. Hey, Patrick, I'm thinking of doing this, et cetera. What do you think, right? Whether you're working with me directly or with the credit union, we're here to help out regardless and give you, if nothing else, a third opinion, right, on what you're doing to make sure you're investing correctly.
All right, we got another one. If you have a pension and a good chunk of deferred comp and drop money, would it be a good idea to convert some of that money into a Roth?
You can, you can. Again, if you do that, the idea is, hey, I'm going to pay taxes now because I think taxes will be more in the future. If you did that, you want to split it up. Let's say, hey, I'm going to do part of the money right now for this tax year, 2024, and then come January, I'm going to do another portion, right? You do it maybe in tranches, right? And then we look at your income. Okay, what's your income? You're at let's say you're 22% federal tax or 24% federal tax. So we want to do a conversion. We want to make sure you don't go to the next tax bracket. You don't make sure you don't jump up to the 30 plus federal tax. So you can do that, especially if you're going to have a pension. If you're going to be in a higher tax, right, you're going to have a pension, you're going to be paying a certain amount of federal taxes for longer term. Also, another thing to keep in mind, if you're going to move out of state, you got to keep that in mind too, because you don't want to do it if you're going to move out of state and pay state taxes here, where you might go to Arizona or Nevada or somewhere else where there's no state tax or really low state tax, right? Our state tax here is 9.3 or higher. So that's something to be aware of as well, folks. Planning ahead. We plan to move out of state. You definitely want to wait till you move out of state and do any conversions or take any money out of retirement accounts and avoid paying state tax if you can.
All right, and then the last question for the night is, how do I ensure my estate is handled according to my wishes after I retire?
Great question. Yeah, we've had a lot. We've done some presentations recently on estate planning. Of course, first thing you want to do is a will's okay, but with the ultimate goal is having a trust, right? Set up a trust. We have partners we use for trust services. Setting up a trust, it sounds like a burden, but it can be as very cost effective, $500, $600 up into, $1,000 or more, depending how complex it is. That's the best thing to do. You want to put all your valuable, your home, et cetera, your homes into a trust. If you have kids, God forbid something happens to you, you write down the trust. It dictates who's going to take care of your kids, right? If you don't have a trust in place, you're going to go to probate, right? The state's going to decide, the courts, and that can take years and years. It can cost tens of thousands of dollars. The trust is your best solution. We do have partners, again, that can help. And you want to say, hey, God forbid, if I'm not here, something happens to us, I want this person to take care of my kids. Also, hey, when my kids, if I'm not here, if something happens, I want my kids at the age of 21 to get this tranche of money. When they turn 25, they get another tranche of money. When they hit 30, whatever age, another batch of money, right? We don't want our kids 19, 20 years old getting a big death benefit, right? 500,000 at once. So this is all important stuff that you want to outlay in your trust. Again, who's going to take care of your kids? Who's going to take care of them better than you, right? You decide, not the courts. When they're going to get the money, right? At certain ages, ideally, right? So they go through it and they're adults. They're making wise decisions. So these are all important things, and the trust is the best way to go.
All right, and then we actually do have an estate planning webinar on October 16th, so you can actually register for that on our website if you want to go more in depth into how to establish a will and a trust and all of that stuff. And the last one, we just got one last minute. I retired after participating in DROP for 2.5 years, and if I began working for a different employer and earning the same income, should I invest my entire pension for another 2.5 years?
Give me that one more time, Zach, please.
Yeah, I retired after participating in DROP for 2.5 years. If I begin working for a different employer and earning the same income, should I invest my entire pension for another 2.5 years?
Yeah, if you can, I would. If you can invest and continue investing, keep that money tax deferred, absolutely, especially if you have another job. I would just continue, kicking that tax bucket down the road as long as you can. because there'll be a day when you don't have that other job and you're actually fully retired, you want to enjoy life, then you start taking out money again at a lower tax bracket. Ideally, are you going to be in state, out of state? So I definitely would, and if you have a job there, you don't need to take money out of retirement accounts, right? That's legacy planning for your kids, yeah, your beneficiaries, estate planning, right? For things that you want to contribute to, maybe a donation. So definitely I would continue doing that.
All right. Well, that is all. Thank you so much. I want to respect everyone's time. So just wanted to remind you, everyone, that the recording will be available tomorrow. So you can always refer back to this if you have any questions. And if you do have any questions for Patrick specifically, you guys can take a screenshot of the slide right here. This is all of his contact information, and he's very helpful, helps out a lot of our members, and would definitely love to help you guys out. But we appreciate you joining us tonight, and I hope you have a good night and a good rest of your week.
Absolutely. Thank you all for your time, and we're here to help. Thanks again.